Hello, everybody, and a very warm welcome to the second ever episode of The Working Trader. Once again, I'm at work, I'm on my lunch break, so I want to try and keep this quick. I want to keep these sort of introduction to the various instruments videos fairly snappy anyway. So last week we looked at stocks and shares, which are obviously a very important part of financial markets, and something else which I think is really important, and probably the next logical step from that, is bonds. So, what is a bond? So if you ever hear people talking about the bond market or the fixed income market or the debt market, it's all the same thing, and it's debt. If you own a bond, you own debt. Now these can be from companies, they can be from governments, and it's essentially the bond is an IOU, and has interest. So when you own a bond, it's basically the person who gave you the bond saying, I will pay you back your initial, which is called the principal amount of money that you paid, plus interest, and that interest will be pre-agreed when you buy the bond. That's why it's called fixed income, because you get a set amount each month, each quarter, each year, whenever the payments are, as opposed to something like a dividend paying share of a stock where it could change over the years. One caveat to this is inflation linked bonds, called TIPS in America, and you've got inflation linked gilts in the UK, and they basically change in line with inflation. So bonds can trade above or below face value. So when you're trading sort of after the auction, after the initial buying of the bond, when you're sort of trading it on the secondary markets with other people, they can trade above or below face value. So the face value would be if you bought a £10,000 bond, that's the face value of it, and they can trade above that. So they could be trading at sort of 11, 15, 20,000, whatever it might be, or they can trade below that. So it could be sort of 5, 7, 9, again, whatever it might be. And this is for a variety of reasons. We won't go into too much detail, but some of it we will touch on the next slide. But first of all, what are the risks and rewards of bonds? Well, firstly, they're a lot less volatile most of the time than other financial instruments. You usually get your money back, so your principal, that amount of money you sort of first put down on the bond, you normally get that back. So if a company was to sort of go insolvent and have to liquidate, you would be sort of further ahead in line to get your money back than the shareholders, for example, who are normally at the back of the line. However, because you've taken on slightly less risk, it's considered a safer investment. There is a limited upside. So, like I mentioned, it's fixed income. You get back your principal, and you get the interest, but that's it. Doesn't matter how well the company does. That's pretty much what you're getting. Now, as I mentioned, if you're trading it on the secondary markets and you didn't buy the bonds at auctions, there will obviously be sort of differences in face value, and you can sort of have strategies around trading that, but for the most part, there's a sort of a fairly limited upside to bonds. Another thing to note is that bonds are inversely related to interest rates. So it sounds kind of counterintuitive. You'd think, well, I get interest on a bond, so if interest rates go up, bond price will go up because there'll be more in demand. But actually, the way you have to think about it is bonds aren't just issued once and then kind of forgotten about until they expire. There are bonds issued, companies and countries issue bonds sort of at varying frequencies. So you might buy your bonds and then they release another round of bonds the next year or whenever. So if interest rates go up, they will be offering probably higher interest rates on those new bonds, which means the interest rate you're getting on your bond is less. So that bond is going to be in less demand because investors will get sort of less monthly or quarterly, whatever the frequency of income is, on the bonds that you have, and they'll want the new bonds instead, which drives down the demand for your bonds, so the price is going to go down. So that's something to note when you're looking at bonds. So that was it, just a quick introduction. We'll have more detailed videos on bonds at later dates, but for now I just wanted to kind of get the basics in these fairly short and snappy videos. I hope you enjoyed it. Let us know what you think about bonds in the comments, and we'll be back shortly with a new video. Thank you very much.